Welcome back to the channel, everyone. If you've ever driven through the rolling fields of Quebec or the vast golden prairies of Saskatchewan or Alberta, you've seen the backbone of Canada's economy at work. It's our farms. But behind those barns and silos lies a story of tough choices, global pressures, and smart protections that have shaped not just what we eat, but how our rural lands hold their value. I'm your host, Ian, and today we're diving into the clash between NAFTA, our supply management system, and those all important dairy quotas. We'll unpack how free trade reshaped farming from coast to coast, why some sectors got a shield while others face the open market, and what it all means for farmland prices today. Let's start at the beginning. Back in the late 1980s, when Canada was staring down the barrel of free trade talks with the US. The Canada-U.S. Free Trade Agreement kicked off in 1988, and by 1994, it evolved into NAFTA, with Mexico joining the party. The big idea here? Well, it was to tear down trade barriers, boost exports, and supercharge our economy. For agriculture, that meant opening doors to massive U.S. markets. Think billions in potential sales for Canadian wheat, beef, and more. But here's a twist. Not every farm could step through those doors unscathed. American agriculture giants, with their scale and subsidies, were ready to flood our markets too. So the Canadian negotiators decided to draw a line in the sand for key sectors like dairy, poultry, and eggs. Enter supply management, a federal framework that's been our agricultural safety net since the 1970s. Supply management isn't about handouts or wild speculation. It's a closed loop system that matches production exactly to domestic demand. Farmers get quotas, essentially licenses to produce a set amount of milk, chicken, or eggs. The government sets these based on what Canadians consume, and imports are capped with sky-high tariffs on anything extra. This puts us in a situation where there's no overproduction flooding the market, no boom and bust cycles. In 2023 alone, this system stabilized prices over 10,000 dairy farms, ensuring they cover costs without relying on volatile global swings. It's federal policy enforced across all provinces, but it hits different regions in unique ways. NAFTA put the system to the test like never before. The US hammered us in these negotiations, demanding we dismantle these protections to let their dairy giants in. These were the milk wars. Trump revived the debate in his second term, calling it unfair and slapping retaliatory tariffs on Canadian goods. But Canada held firm. Supply management was exempted from NAFTA's core rules. We kept our quotas intact with over 200% tariffs on excess dairy imports, acting as a fortress wall. Fast forward to the USMCA in 2020, and we conceded a bit more access. About 3.6% of our dairy market opened up through tariff-free quotas. That let in around 50,000 extra tons of US milk products annually, but it was a drop in the bucket compared to our 8 billion liters of domestic production. The result? Well, our farmers dodged a bullet, preserving jobs and steady incomes while grains and other crops charged ahead into the export territory. Now, let's break down the two worlds of Canadian farming under this pressure. On one side, the protected trio, dairy, poultry, and eggs. These make up about 40% of our farm cash receipts in those categories, concentrated in the East. Supply management delivered stability. Farmers knew their milk would fetch a fair price, without the heartbreak of dumping surplus at a loss. In Quebec, where dairy is king, with over 4,000 farms, this meant families could plan expansion or pass operations to the next generation without any fear. Ontario's poultry sector, with its 1,200 chicken quota holders, saw similar steadiness. And egg farmers, they really kept flocks just humming along at consistent levels, avoiding the feast or famine of open markets. Contrast all this with the open fields and grains in the prairies. Wheat, canola, barley, the export engines of Alberta, Saskatchewan, and Manitoba. These weren't shielded really at all. NAFTA flung the doors wide open. Pre-NAFTA, the crow rate subsidy kept grains transport cheap with prairies to ports, but they ended in 1995, forcing farmers to pay a full freight. Since then, exports have boomed. Canada now ships over 20 million tons of wheat yearly, much to the US and Asia, but at a significant cost. Global prices dipped in the 90s, squeezing margins until farmers adapted. They scaled up. Average prairie farm size jumped from 800 acres in 1990 to over 1,600 today. Tech rolled in. Precision seeding, GPS guided combines to cut costs and boost yields by 20 to 30%. Some switches to high value crops like pulse lentils or organic canola, tapping niche markets. So it really comes down to stability against competition, which really sparks endless debates and supply management's right in their crosshairs. Proponents, farm groups like Dairy Farmers of Canada, argue it's a win for everyone. Fair returns for producers means no need for massive subsidies, unlike the US $20 billion annual agricultural bailouts. Consumers get consistent supply and top tier quality. Our milk's hormone-free standards are the envy of many. Plus, it bolsters the rural economies. Those quota farmers pump $20 billion into communities through jobs and local spending. Critics, though, well, they point to higher prices. Dairy costs Canadians 10 to 20% more than in the US, adding up to $1 to $2 billion extra yearly at the checkout. New farmers face barriers. Buying a quota can run $30,000 per cow in Ontario, locking out young entrants. And in trade talks, it irks partners. The EU and the CPTPP deals chipped away our protections, forcing quota tweaks. Politically, it's a third rail issue. Rural ridings in Quebec and Ontario vote en bloc to defend it, of course, while Prairie MPs push for freer markets to match their export focus. These tensions play out regionally, creating a mosaic of adaptations that ties straight into real estate. So, what does this really mean for us today? Agricultural under NAFTA's shadow shows how policy can balance global ambition with local survival, protecting some to let others thrive. Looking at all of this, I would love to know your thoughts on the actual quotas themselves. Do you think they help Canada and help it grow, help it be stabilized, help the average Canadian? Or do you think free trade would be better off by providing more competition and more opportunities for growth and a little more push for better prices and better products? Let me know in the comments. Thanks for joining me, and I'll see you on the next one.